Good morning and welcome to this Wednesday, February 5th edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it was another great day on Wall Street. Big rebound. We actually saw the NASDAQ move to an all-time high yesterday. So at least from the NASDAQ's perspective, the correction is over. We are moving higher. Earnings season has been very strong. We're going to go over a number of reports, but mostly companies are coming in with better than expected earnings and in many instances raising guidance. And for those companies, earnings are extremely valuable in this kind of a environment where we've got historically low interest rates, moderate growth, the Fed on hold, inflation low, lower than expected. And so that environment really plays into growth companies that can continue to not only increase its earnings, but increase its earnings growth. That changes valuation models. And again, with low interest rates, those earnings become extremely valuable. And I think that's what folks are going to continue to realize throughout 2020 and beyond, that it's not just about growing 2 or 3%, but in a low interest rate environment, that 2 or 3% or 5% can become pretty valuable. And the companies that are really expanding rapidly, those are the companies that we see just literally going off the charts to the upside. We shake our head, don't quite understand it, but you got companies like Apple and even Tesla. Tesla really being driven by a short squeeze as well, maybe the mother of all short squeezes. But let's go ahead and take a look at the action from yesterday, and then we'll get everything going, get into a bunch of earnings reports today. All right, start off with the Dow Jones, up 407 points. It didn't quite close as high as we did at the end of January during our first initial attempt to go higher, but I can see on most of these indices a move down, a quick bounce up, and one more move lower. The NASDAQ's an exception, but that is an ABC correction, which can be all we get in this pullback. I mean, we may be ready to roll again to the upside. The Dow again up 407 points, the S&P up nearly 50, more than up 1.5%, and it did clear its reaction high back at the end of January, as you can see. Hasn't taken out the all-time high that we saw back in mid-January, but pretty nice day today, and we could be there, pretty darn close to there. The NASDAQ makes that breakout, 52-week high. We'll want to watch the volume. We'll want to see what the other indices do to see whether they confirm. I will say that we are breaking out with a negative divergence. Now, we could see prices continue to go higher and higher. You can see that PPO starting to turn up. It can be eliminated. Just because you see a negative divergence doesn't mean that it's going to take prices lower. We saw this in December. When we broke out in December here in mid-December, look at where the PPO was. It was clearly a negative divergence. But what happened? We kept going higher and higher. PPO went higher and took out that prior high. That's why when I see these breakouts, a lot of times I look for a big reversing candle. Like we had something really good to hit the market. We had a big gap up, and then we sold off all day. And you look down here and the volume is one of the heaviest that we'd seen over the past 3 or 4 months. That type of reversing candle with a negative divergence, that would suggest maybe we'd be a little bit more cautious. But right now, we're getting a breakout. Let's see what happens with the other indices. This could be the end. This could be that ABC, and off to the races we go. Mid-cap 400 did break back up above its 20-day moving average, which was good. Small caps did not. We did have a nice day yesterday, up 1.25%, but this one's still in a downtrend. And you can see that relative underperformance of mid-caps and small caps is still there. Just simply by looking at the charts, I can see that it's just not performing as well as the other major indices. Yesterday, more good news in the sense that aggressive areas of the market were leading. Technology breaks out. Industrials testing a downtrend line, but industrials, one of the 5 aggressive areas of the market, also up almost 2% yesterday. Consumer discretionary, big pop again, 1.8%. Got to watch Amazon. I'll be talking about that later in the show. But Amazon is 23% of the XLY, and Amazon is looking very good to me. Materials, I was looking for materials and energy both to rebound. Energy tried yesterday early, and then the crude oil prices fell again. And so they gave up a lot of their gains. I still think that energy is down at a key support level, and materials, if the dollar retreats, as I've been discussing this week, then I would certainly look for materials and energy to begin to lead, or at least perform a lot better than they have been. Also, healthcare had a nice day yesterday, coming up, and it's challenging its 20-day moving average. We'll see if we can get through. You can see that there was a negative divergence on the XLV. There was also a negative divergence on the XLK when it was going, or excuse me, the XLY when it was going higher and fell back, hit its 50-day. XLV went just below its 50-day. You can see that center line reset on the PPO there. We got close to the center line on the XLY. That's what I look for when we get those negative divergences. If we can't seem to keep it going to the upside and we start to break down, I look for those 50-day tests and PPO centerline tests. And essentially, we got those on the XLV and the XLY. The 10-year Treasury yield, you can see it is up again today after declining pretty rapidly throughout most of January, especially the second half of January, this huge decline. All the stock market did was consolidate. This is a signal of a secular bull market. As soon as the 10-year Treasury yield starts to go up, that money coming out of the treasuries goes straight in the stock market, and the stock market takes off. It's kind of hard to believe, especially when you get used to what we saw during the secular bear market throughout most of this century, where every time we had a big drop in the 10-year Treasury yield, it resulted in a big drop in equities. It's not happening anymore. I wouldn't look for that to happen. Instead, coming off of these very, very low interest rates, when we get any kind of a pop to the upside, that money rotating out of treasuries that's causing the yield to rise, that money almost always is going to go into the equity market. So when we start to get a move like this, this also is making me more bullish in the near term because it seems like we now have found that bottom down closer to 1.50. Next test is going to be to get through resistance here at about 167, 170, and look at that 20-day sitting at 1.685 right in the middle. So this is going to be a key area. If the TNX goes through that level, and I have my doubts because I actually think the bond market is signaling to the Fed that, hey, it's okay if you want to if you want to lower rates one more time. So I've read something. I don't really look at what's being priced in, technically priced in, but I did read an article a couple of days ago saying that maybe mid-year that we're being priced in for a rate cut by the Fed. And I'm okay with that. As I've said, we've got moderate growth. We're not cutting because of growth issues. The economy is fine based on just about everything I see. I think the economy is pretty strong. It's not about the economy. It's about inflation. It's about the stabilization of prices. That's one of the Fed's mandates. Everybody thinks it's just growth. You know, are we growing? Okay, we should be raising rates then. Well, that's not the case when you've got inflation tracking below that 2% target level. This is actually nirvana for equities. A Fed that's sitting on its hands might even lower rates while we've got moderate growth and with rates sitting down near record lows. Earnings, especially earnings growth, becomes extremely valuable in this kind of environment. All right, let's move on to, I want to go through some areas of the market, looking at industry groups relative to the S&P 500. So I'm going to start in the technology sector, and I just want to go through these. I'm going to go through pretty quickly. I look at these quite a bit. At least once every week or 2 weeks, I'll go flipping through every single one of these. So I'll just go rapidly. What I'm looking for is industry groups relative to the S&P that are above the 20-day, and I really like to see the 20 above the 50. So my configuration would be more like what we saw here with computer services back in July, where you've got the relative strength line moving up. It's above its 20-day moving average, which is above its 50, and all of them rising. Now, you can see here the 50 never quite started to rise. The 20 quit, rolled over, and then we went back into this downtrend. But the more you look at this, I think the more you'll grow accustomed to seeing the areas of the market that you want to be in, or that areas of the market you don't want to be in. In other words, if I was looking at a computer services company with this kind of relative downtrend, I would need to see probably the best computer services company before I'd be even thinking about trading it, because I'm not in an area of the market that it favors, that Wall Street favors. So let's just go through these technology industry groups, and you can see computer services first, downtrending. Semiconductors, is there any reason why semiconductors continue to go up and their earnings are strong? Well, of course there is. It's because Wall Street's been out meeting with these companies. They know that this is an area of the market where you want to be in, and it comes through, it comes shining through when you look at the relative strength. Semiconductors relative to the S&P have been uptrending now since basically a double bottom that formed in May. You can see price actions above the 20 is above the 50. Everything's going up. PPO is strong. Anything above 2 on the weekly PPO is going to be a pretty strong group. Software. What more do I need to say here? I mean, software has been a great area of the market. You know, we had that little bit of difficulty last year, September, October, when value came into play, and then growth came right back, and boom, software takes off. Then we've got electronic equipment. This has just been kind of a, you know, back and forth. I'm not really seeing anything. When you see this movement above the zero line, below, above, below, and you see all these crosses above moving averages, above, below, and that just tells you there's really no real relative trend in play here. So you might find individual stocks, but they're not going to be supported the way they are in the semiconductor and software area. Computer hardware, again, what can you say? Great area, Apple, obviously one of the key pillars of strength here in the computer hardware group. We get into electrical components, just set a new 52-week relative low. Not going to be interested in all there. Telecommunications equipment, same thing, been downtrending forever. Yes, you'll find a stock here and there that you can trade. But again, when you've got this kind of relative weakness in the overall group, if you trade an individual stock within the group, I would make sure I keep my stop in play. Because if all of a sudden it begins to underperform its group and you see that the group is this bad, those types of stocks could get hit pretty hard, pretty quickly. So those are the technology. I'm also going to go through, I want to go through, let's go through today I'm looking at the time. I'll tell you what, I'll do consumer discretionary, but I'm going to go through really quickly because there are 20 of them, or maybe a little over 20. All right, here we got hotels, I would say just kind of flat. Toys, downtrending, consolidating a big downtrend. I don't think it's really made up its mind which way it wants to go there. Restaurants are one that I was hoping we were starting to see strength. I wanted to see that move back above the 20, and it looks like now it's starting to roll back over again. You know, you still got your great restaurants out there like Chipotle that have been great performers, but you do have to pay attention to the fact that the group's not getting a lot of love right now. And so if I was in a stock like Chipotle, which happens to be in our model portfolio, I would just make sure I keep my stops in play if it were to really break down. And I'm saying, you know, probably a move back below the 50-day moving average would be something I would begin to look at. Specialized consumer services also, this was a leader up until August and just has not been able to regain its strength. Wanted to get it through that 20-day. It seems to be rolling over. Clothing and accessories, not much to like here, down near a 52-week low. Home improvement starting to show strength, and this is a group that overall long-term has been higher, but the short-term has been weak. I would really like to see this one get back through those moving averages. Recreational services, no thank you. Retail, apparel or apparel retail, been trending lower. It's close to its 20 and 50. It's not a horrible group, but it definitely has a relative downtrend slant to it. Specialty retail is one that I almost wrote about this in the EarningsBeats digest this morning. Instead, took a look at Amazon and broadline retailers. But specialty retailers have a really key support level here that I would like to see hold, and it's starting to turn back up. So I think this one's squeezing in this very narrow range. Which way is it going to go? That's going to be an interesting question. Travel and tourism, down near the relative low. It's not being helped by the coronavirus. I think it was starting to show some strength, and the coronavirus and it's just weakness here in January really setting that up for perhaps more trouble ahead. Gambling had strengthened quite a bit over the last 4 or 5 months, and then in January dipped, but notice it held the 50, coming back up above the 20. The 20 is above the 50. This is another one that's begun to show some relative strength, but is it just consolidation after this long downtrend? Another breakout would be very bullish. Relative breakout would be bullish here. Home builders, still, you got to love home builders with rates as low as they are. Now, are we going to see a little relative pullback? Well, if the 10-year Treasury yield continues to move up, then yes. I don't know that the 10-year Treasury yield is going to go up much, though, with inflation being what it is. So I still think home construction looks pretty good. Here's broadline retail moving back above both its moving averages, and you can see down here on an absolute chart just breaking out. Again, I'll talk about Amazon in a bit. Furnishings started to strengthen for a few months over the summer into the early fall, and then right back down near 52-week low. Hard to like what's going on there. I think the footwear group still looks pretty good, consolidating, PPO well above 0. We've just moved back above the 20, which is above the 50, and just about everything's moving higher. I think footwear is okay here. I'm not interested in business training. And, when I look at a chart and I just see straight down, another one here, pretty much durable household products, I'm just not going to be overly thrilled. Again, am I going to find a stock that I could trade in these groups? Of course. But, it's going to be hard. I'm going to want to definitely keep a tight stop. Automobiles. All right, this is Tesla. You can thank Tesla for this one. Huge, huge move up, but it is Tesla's unrelenting advance. Although yesterday Tesla put in a doji, sold off heavy in the final hour and got a downgrade today. So maybe in the short term, we may have seen a little top on Tesla. Recreational products. I do like what's going on here, but I'd like to see another breakout. A relative uptrend consists of a move up, a move down, another move up. We haven't seen that breakout, another move up. That's what I'm looking for here. Auto parts, another relative 52-week relative low. Broadcasting and entertainment is the one that's in this group. I actually, even though it looks bad, I actually still like it. And the reason I say that, number one, it's got the absolute uptrend in play. Number two, higher high, higher low, higher high, higher low, higher high. So far, still a higher low. I know it's been weak for the last 6 or 7 months. I think we could be starting another uptrend here. Disney reported this morning up just a little bit on a pretty good report. Nice beat on the bottom line. We'll see whether or not this group begins to pick back up again. Media agency, well, this goes into communication services. I want to get into earnings, so let's go ahead and move. But you can see media agencies in the communication services group, not an area to endorse here for sure. All right, let's talk about some individual earnings reports. First, let's look at Disney. Disney did come out with its earnings. They beat on their bottom line, $1.53 versus $1.43. I saw the stock up about 0.5% in pre-market. It's been a pretty nice reversal off of this 135 area. Coming down off the downtrend, you can see a doji, and then after it looked like we were gapping down to a new low, nice piercing candle off this downtrend to launch Disney the last few days. Nice recovery, $10 in 3 days. And with the earnings, I don't think it's going to hurt. I suspect we're going to get another breakout in Disney. I like the stock further down the road in 2020. And so I think that this pullback is an opportunity, and I don't see anything wrong with Disney at this point. I want to pull up a few that getting some positive responses here. Chipotle, I mentioned Chipotle. It beat on their bottom line, 286 versus 274. The stock up a couple percent in pre-market. Been moving higher. This is one of the leaders in restaurants. So again, when you're looking at a group that has not exactly been a favorite of the S&P 500, I said, you want to be in one of the leaders. Well, I think clearly CMG is one of the leaders. Now, it did weaken versus the S&P 500 during this period, but since it began rallying again, it has been leading the S&P. That's the goal. So if you've got a stock that's leading a weak group, but it's still not leading the S&P, if it's leading its peers, but it's not leading the S&P, well, that's probably a stock I'm going to pass on. I want to see a stock that is performing well enough to outperform the S&P 500. So if you get a leader in a downtrending group, but it can still do this, then I'm okay with it. But again, I would be watching maybe that 50-day moving average. We've moved up above maybe even the 20 for those of you who are more short-term oriented. But it does look like with its earnings, it's going to gap up again. Microchip, MCHP, also coming out with a nice response to its earnings. It posted earnings of $1.32 versus $1.26. Stock is up almost 4% pre-market. It is in the semiconductor space. It's in a great area of the market, but microchip has been one of the worst performers. It was down near a 52-week low versus semiconductor. So I think it's definitely benefiting from the tailwinds of the group, but I don't know that it's going to be one of your better stocks here. Even a move of 4% today, we're talking maybe $4. That puts it up maybe around 105, 106. That's still in the middle of this range. It's in an uptrend, so it's not bad. It's just that there are a lot of other semiconductors that I prefer. Cerner, CERN, also performing or having a pretty good report. 75 cents versus 74, up a couple percent in pre-market. Watch the breakout level because I see an uptrend in a long-term cup with a handle. Your breakout level, 75.92 is the high candle body back on July 12th. And 75.96 is the high on January 22nd. So if this stock were to open up, say, at 75.96 or above, especially over 76, I think that would be a signal that we could be seeing the next leg of this rally. So CERN is definitely one that I would be keeping a close eye on. Based on the way it's trading in pre-market, it could be very close to that level when it opens. All right, IPHI, here's another one. This is in the semiconductor space. Nice report. These were all reports out last night, by the way. IPHI, now this one is close to the lead. It was actually at a 52-week high relative to semiconductors back earlier in the month. So now you've got a stock that's one of the leaders within one of the best groups. So this is a stock that I would definitely be favoring in the group. They did beat bottom line 47 cents versus 45. The stock is showing that it's going to open about 3.5 to 3.75% higher. And that could be a breakout. It's probably going to be very close. And your breakout level is 85.02 on the open. So I'd like to see an open at that level or above, especially preferably above. Like 85.03 to me is much better than 85.02. And I do look at it by the penny when it comes to a breakout on the open. Trust me, market makers know where those levels are. All right. There weren't all great reports, though. I'm going to bring up one, Ford. This was a company I did not like going into earnings. And although autos are flying, Ford is not. So on a relative basis, you can see Ford. It's hard to keep up with the auto industry, to be honest, though, with Tesla leading it to the upside. But Ford's been going down since back all the way in the beginning of June. Tesla's been running for the last month and a half. So Ford has not been a good performer for a long time, and they missed again. 12 cents in earnings. Market was expecting 17 cents. Stock's down 7.75% pre-market. Ford is just, look at this long-term chart on Ford. Okay, they got a dividend. Nice dividend. That's all you're getting into it for. The stock's been trading down now for 6 years. Just in this bull market environment, I will pass on the 5% dividend. I know, and how much the stock has lost $13 down to $9. So have you really made anything on the 5% dividend? I don't think so. All right, let's see, what else do we have here? A couple more maybe quickly with earnings. Snap. Now this one was a little surprising. And again, still reports from last night. I'll give you a couple from this morning real quick. But Snap, let's go look at this on a relative basis. So you've got the internet group, which has been strong, and Snap was starting to strengthen again. Now, it did go through a period where it had underperformed, but it was starting to strengthen. I think the volume trends were pretty good, but they came out and they beat bottom line, by the way, 3 cents versus being flat. But the stock is down 7% pre-market, 7.5%. Now, it could be that you see a gap down, a big red hollow candle. This is the one thing we never can predict. I can say with pretty good feeling that a company is going to beat its earnings estimate based on the way it's trading. But what I can't always say is that it's going to go higher with that report. And this is a perfect example. I didn't see anything that was horrible. I didn't see the guidance. But Snap being down 7.5%, there must have been something with its guidance going forward. But again, if you can beat estimates, and then lower, you're being cautious. So a lot of times these gap downs are opportunities. It'll be interesting to see how Snap performs later today. I'm not going to show it. KLA reported last night, KLA 10 core, KLAC. They are down 3% in pre-market, but they did beat, again, bottom line 266 versus 255. A couple of companies reporting this morning. Merck beat 116 versus 114. I didn't see the pre-market for the companies that reported this morning, but this one on a relative basis has been downtrending versus pharma. Is not really that excited about it. Humana reported this morning. They beat 228 versus 220. Looking at them, they were a leader relative to healthcare within the last month. This is a stock that I probably could get behind. Let's see what kind of reaction we get today on this one. Spotify came up way short of its estimates, and what I'm showing is a loss of $1.26, and the market was only expecting a loss of 148, or excuse me, 48. So this is one that kind of looks strange to me. I'm going to see if I can just get that one quickly on, get you a pre-market read on that stock. It's down 4.8%. So down $7.50 right now to 148.50. So it's back down this area. So it looks like it's just more sideways consolidation. Spotify, what I would be watching here without a doubt would be a breakout above 160. So until it does that, problem is within the internet space, it's not a leader. So if it could break out above 160 and start to show relative strength versus internet, then I would be all over it. Until then, I think it's just a watch, maybe a hold. And with the weakness today, if it breaks down below the 140 level, maybe it would be more than just, maybe a sell. All right, let's see. Got a couple upgrades and downgrades. So let's start with the upgrade. BMCH. This is a company that was upgraded. It is in that home improvement area. Remember I was talking about home improvement where I'd like to see it turn back up. It's been a pretty good area. Well, look at it on an absolute basis. We're trying to break out in home improvements. If we get that breakout, I think you're going to see this relative strength line turn up. And this has been one of the better stocks in the home improvement area. Here is the overall group relative to the S&P starting to turn back up again. You can see BMCH maybe flattening against its peers, but I think I agree with this upgrade. I think as long as it holds, I'm going to say $28. I think this one's got a really good chance to go back up to its recent highs. Other upgrades, CNC, ETN, Toll Brothers, TOL, pull that one up real quick. Toll Brothers had a huge move in January. You can see the relative strength. I mean, the overall group had a huge move. So it went for the ride and actually outperformed a little bit, but the long term is that Toll Brothers has not been one of the better performers. So I'm okay as long as it holds the 20-day, but really be careful if Toll Brothers begins to roll back over because there are other home builders that I think look a lot better. Downgrades, ALB, Albemarle, Gilead Sciences, Seagate Technology, STX, Sherwin-Williams, and then Tesla. Let's pull up Tesla. Being downgraded today. That's a doji off massive volume off this uptrend. I actually agree with this downgrade in the short term. I think looking at, I saw this at the close yesterday. I was thinking, okay, if this doesn't stop Tesla in the short term, I don't know what will, because the stock traded down about $60 in the last hour yesterday, or maybe I'm kind of guessing, trying to recall. Let me show you what it was. Maybe $70 in the last, and not even in the last hour. It was actually in the last 10 minutes, 15 minutes. So definitely it looks like this is a stock that maybe has reached its peak and is ready. That might even be market makers getting on the short side. So I'd be looking maybe for a little bit more downside here in Tesla. All right, running behind, but I want to go into the three you must see. I'm going to start off with Zimmer Biomet, ZBH. It's going to help if I get the right ticker in there. Oh, let's try this again. Actually, I might not be able to bring it up. Let me just tell you, you can look on your charts. ZBH on a weekly chart, it broke out recently. And maybe no, it's just not. was hoping maybe to get it. All right, seems like oh, maybe I can get it here. Now, my computer, I'm not sure what's going on here. Hopefully I didn't lose everybody. But look at ZBH on a weekly chart. It broke out recently. It just broke out again with earnings. I think that one looks good. LK, which is, I think, Luckin Coffee. Very, very volatile stock. Looked like it had broken down recently. Coming back up. Watch it at the 20-day. I think we could get there, but the 20-day might be difficult. And then finally, Amazon. I wanted to show you, if you're a member, if you're a subscriber to the EarningsBeats Digest, then you'll know that that is the company I featured today. Big ascending triangle. So really good looking chart on Amazon, and broadline retailers look good as well. I have a measurement on Amazon on this breakout to 2,800. So I really like Amazon going forward. Anyhow, that is it for the day. I hope everybody has a great day. Be back tomorrow over at Stock Charts TV. Happy trading, everybody.